benefit of everyone that is in attendance and who will watch this later, Greg, you've been in the industry for over 25 years, I believe, in one form or another. You've been investing in real estate since 1997. Centurion has been around for how many years now?
18.
18 years. Fantastic. And I'm just going to remember to bring my mic a little closer here too. 18 years. And in that time, the Centurion Apartment REIT, which is our preferred asset that we use with you, has had an annualized rate of return of 13.8%, according to your last update. Mm-hmm. And inside that REIT, 68% of the apartments that we hold are in Canada, 3% are in the United States, 9% of the portfolio is student accommodations, about 5.3% is direct holdings in mortgages or actual equity, which has been accrued by the fund probably earlier. And that builds to a wonderful portfolio of 82 distinct properties, 11,786 rental units, across 28 cities in 2 countries, which is pretty astounding. So I'm very much glad to have you here. I know that you have got some very strongly held opinions, and I'm going to bug you today about some of your views about the Canadian real estate market, inflation, and some of the risks to value of the portfolio itself, which is stuff I'm fairly confident that you normally have some things to articulate around. But where I want to begin is the fund has just reopened. You were doing $150 million raise.
Mm-hmm. That's right.
So I thought this would be a good time for, in your own words, to just walk us through what are people buying? If they're contributing today, what is the REIT going to buy? And how does that improve the overall health of the REIT? Where's the opportunity? Why do you choose now to do it?
So, last year I had said that I believe that the next 12, 18, 24 months, we would see a tremendous amount of activity. Once we got past the initial shock of COVID, so a lot of buyers like ourselves, even sellers of properties, went pencils down from March to September or so. Just because no one really had a lot of visibility and we're really just focused on operations more than growth, right? I think everyone, that was their priority at the time. But my view was, look, and I've said before that Canada's going to build more apartments in the next 10 years than we've built in 2 generations. And there was a lot of developments out there, and a lot of those developers, I think, were probably over leveraged and also underestimated the operational intensity of running apartment buildings. So apartments are one of the most forgiving asset classes in my view. But COVID somewhat upended the model, right? Because it used to be, look, if you didn't maximize your rents and you didn't work too hard to market your buildings, there was always such a shortage of them, and a lineup of people to come in. Oh, hold on, I got an uninvited guest here. I'm gonna put out of the way. Sorry about that. That, it was always easy to keep your buildings full, but with COVID, people did want to move. Renting your units now became a little bit more challenging because you needed to do it virtually. A lot of people didn't have the infrastructure to do that. Residents who prior to COVID would let you tour a potential new renter through their unit refused to do that because no one wanted COVID coming into their home, particularly in the early stages when everyone was like, oh my God, this is the bubonic plague. So what did that mean? Didn't mean that you couldn't adapt around it, and I think we did very well. But it meant that operating apartments became a real operating business in a way that I think many of the old school owners and probably some of the developers who got into the business and thought, oh, we'll just build them and keep them, realized it wasn't anymore. And they were out of their depth. And, maybe with the capital markets becoming more volatile and they're very, very leveraged, decided, well, the banks didn't want to deal with highly leveraged or inexperienced operators in a time of volatility. So I think that was going to, my thoughts were that was going to motivate a lot of sales of these developers when the market opened. And we were right. I mean, we've been very active in that space. And one of the things that I think it's going beyond that now. And, I think this is an important thing to understand why I believe that the opportunity set for us for growth in the next 2 years is probably greater than any time in our history is you think about life inertia, right? And just like that COVID was disruptive, it forced people out of inertia, which is life inertia is to do tomorrow and today what you did yesterday. And I think a lot of people got shaken up in COVID, not necessarily because they did bad, but maybe they saw someone else do bad, or they saw restaurants close or retailers. And a lot of the source of opportunities in our industry comes from a retiring family, right? Who's saying, I'm 60, 70, 80. It's time for me to move on and go to a beach. I think at more time than any recent time in my experience or my career, people are examining their lives. And this is not limited to apartment owners. This is everyone, right? Um, and I think we're seeing a number of families, not only in my circle of friends, but people I know, it's not just real estate, it's a lot of businesses are just, okay, this is the time that they've been shaken out of their inertia and are looking to sell their properties, portfolios, or business, whatever. So I think we're very well positioned because not only do we have the infrastructure to onboard opportunities, we've got the capital to do it, we've got the ability to raise new capital for it, and in the market that we're first call or one of a few people they get called for opportunities. So I just think this is going to be a great time, and that's what's happened is we've gotten a lot of opportunities. We can see the pipeline ahead, and we need to get ahead of it and have capital to close them.
Okay. Not all the opportunities can be equal, though. I've noticed in the last few years, the portfolio has added positions in Atlanta, Texas. Mm-hmm. You've built, I believe, purpose-built apartment buildings in Texas, and I think you've described them as being quite a bit more luxurious than what the Canadian market is used to. Mm-hmm. Where will you be looking right now? Like, is the opportunity, the Canadian market is obviously, I want to talk a little bit about that, but just generally right now, where is the opportunity geographically for the REIT?
So we're doing a lot of stuff in Quebec. Quebec is one of the largest renter provinces in the country. So it's the largest rental market in Canada. It's where they build a lot of new product, much more so than gets built in Toronto. In Ontario and provinces outside of Quebec, it is very much a ownership market. People buy condos, they buy houses. And Quebec, it's much more a European type mentality where a lot of people are happy to rent and then spend their capital on other things, lifestyle, etc. So that's why it's always been a great place to develop. And there has been a lot of new purpose-built construction, and it's relatively inexpensive. I mean, Montreal, Quebec, very affordable places. So for that same thing I said before, I think a lot of developers are getting shaken loose to do something. So we're seeing a tremendous amount of opportunity. BC also, I think a lot of people got forced out of Vancouver because it's just so expensive. So we're seeing opportunities in the suburban areas outside of Vancouver. So Victoria, Burnaby, Surrey, these kind of areas. And we think there's lots of opportunities there. So much less so than the United States so we're kind of pencils down in the US, not because we've turned our view on the US, but the opportunities are so good in Canada right now. And I think that the fundamental tailwind is stronger here. In part because it's very hard to build new supply here. That's why house prices are rocketing. It's not just because interest rates are low and people want to move, but supply constraints are keeping new product from coming to market and satisfying some of that demand.
So 2 points on that. It's quite interesting. Just recently, obviously lots of stuff if you follow City Hall in Toronto, there's lots of resistance to any kind of development Christy Wong Tam, who is the city councillor for Toronto Centre, has opposed development at Yonge and Bloor. It's maybe the wrong place. I mean, I don't know where else you can put density if you can't put it at Yonge and Bloor. And recently led a charge against a tear down of a factory that hadn't been, had been 100 years old and hadn't been touched since the 80s, as a historical monument and significant, architectural thing that needed to be protected.
Heritage or whatever.
Yeah, exactly. And but then I found quite interesting, though, is that even up at Yonge and York Mills, which, if you're familiar with the intersection, has got an office building on one corner, a gas station on the other, open parkland, and a parking lot. The parking lot is due to be turned into about 400 units across 2 towers. Mm-hmm. And it has been resoundingly opposed by pretty much the whole community, primarily through, I think, Hogs Hollow and the Avenue Road, whatever association. Yeah. And the city council set it back to be reviewed. So they put a kibosh on it. I mean, it's been sitting empty for years. And you'd think if you can't build there next to a highway, next to a ghost stop, and next to a subway terminal, where can you build in the city? Yes. The other thing I was going to ask is I've recently come across a book called The Human City, and he's making an argument contrary to what we hear a lot about the importance of densification and all this. He's pointing out what you're pointing out, which is that density actually goes down the bigger a city gets, and that it is in the suburbs that you get new development. So it's not Vancouver, but Richmond. It's not Toronto, it's Mississauga. Is that where the focus is when you guys are putting up, or I don't know if you're building buildings at the moment or if you're just buying buildings at the moment, where do they tend to go up these days?
Well, there's a couple of reasons why that it's going to the suburbs. If you think about the suburbs and the exurbs, or the exurban areas, Toronto's a condo market, so a developer can build something, sell those condos in advance to get the financing to build them. But the suburban markets aren't really condominium markets, right? So just because it's harder to sell them years in advance. It's just not what people are used to in the suburbs. So as a result, more rental gets built. Now, if you don't have the competition for that postage stamp size piece of land, I mean, in Toronto, getting a developable land costs you, call it $200 to $300 per buildable foot, which means it's $300 to $400 for, per square foot of living space, excuse me. In the suburbs, like you go to something like Guelph, you might be buying $30 a square foot buildable. So it's a tenth of the cost. You're saving $270, $300 per square foot on just land, let alone labor and, all these other, development charges that the cities love to charge us. So it's just, you can just make the numbers work. The other thing is, because land is so expensive, it relies on density. So if you want to build something at Yonge and Eglinton, you're pretty much forced to build 40 stories. Concrete, very expensive, takes lots of time to get approval. You have to fight like hell to be able to get it because no one wants that new building in that area. Now, and then you have to do 5 stories of underground parking, which is expensive and it's risky. But you go to Guelph, let's say. Now you can do surface parking. So you save a ton on having to do undergrounds. And instead of having to go up 40 stories, you can buy a site and put up a 4-story building. And as a result, you can use a cheaper technology like wood as opposed to concrete and steel. So it's faster. You have less opposition. The cities are generally more development friendly. And, to the extent that you have capital tied up for 7 years or something like that in a high-rise development in Toronto, if you can do that in half the time or a third of the time in the suburbs, that means you turn your capital faster, right? And that means you've got a lot more room for if there's a mistake or time overage. So as a result, I think the real opportunities really are in the suburbs where the vast majority of products getting built. The pandemic, I think, reinforced these trends because look, people were stuck in cities in a 40-story high rise, waiting 15 minutes, 40 minutes, half an hour, however long to get an elevator to go down.
Yeah.
And they're paying for this exorbitant privilege to live in a 400 square foot unit and with nothing to do and trapped in their unit. And now they can take the same amount of money and go to the suburbs, get an apartment that's 2 or 3 times larger. By the way, it's, they're on the second floor so they can walk down, so they don't have to wait for anybody. And they got parks and lots of things to do, and they can work from home. So it is really upended, I think the tastes of the public and the desire of the public as to where they want to live and where they're now able to live.
Okay, so let's use this as a transition point here, because we're talking about the economics that make certain livable situations make sense.
Mhm.
You've had some very strongly held views about the overall Canadian economic situation going back the last 7-8 years that we've been working together. Today, when we're looking at the Canadian real estate market, and obviously there's a distinction here between the apartments that we invest in and what we hear about every day. Give me some commentary then when you look at the real estate market and you see prices up 50% over 6 months, 25% over 1 month. What's happening? Canadians were already the most in debt group in the OECD going into the pandemic. Now we've funneled billions and billions of dollars. I think $20 for every dollar that was lost in the pandemic was pumped back into the market. Central banks are keeping rates very low. We're watching now a housing bubble that already seemed very bubbly to begin with in 2019. So how do you feel about that?
I'm concerned about it. I mean, I understood and I called out very early that there would be pressure on the suburbs. There would be a pressure to get houses, lower density forms of housing, lower density forms of office space, and that was going to be problematic for downtown core properties. But the absolute, explosion in prices, I don't think anyone could have called, right? I expected those to be tailwinds, not a gale force tailwind. And I think it's going to have some significant repercussions because I believe, if we look at the underlying economy, it's extraordinarily weak. And it's built on a house of cards made of debt. So I am very concerned that when the economy actually starts to reopen and some of these supports get withdrawn, that our market is probably, and I say our market, I mean Canada, residential housing is, on, I think, unstable ground. People have taken on too much debt to do it.
What's the knock-on effect of that, though? We tend to think about the housing as being, it's a personal thing. I have a mortgage. My house is worth less. I have to keep paying my mortgage, regardless of whether or not the house is underwater on that debt level. But it's connected to some pretty serious major financial institutions in Canada that have been pretty proud of themselves since 2008 for sidestepping exactly this problem. What do you think the effect will be on the Canadian banks if we do face a real housing crunch?
So, last fall, I think you might remember, I put out a white paper that I shifted kind of almost a decade or more of a deflationary thesis on, or, low rate disinflationary environment, to one where I think we're moving to a stagflationary environment. I believe that interest rates are going to be artificially suppressed like they have been for more than a decade. Now what we're going to see is negative real rates, and in a very significant way. Now, there's some data out recently that the Bank of Canada owns 40% of all outstanding Government of Canada bonds, which I just find to be unbelievable. It's more than double the amount of monetization that the US Federal Reserve has done. I think the Government of Canada is very much trapped. And so is the Bank of Canada. They can't let rates go up because it'll collapse everything. The other thing that I've said is I believe that inflation is starting to permeate through. If you look at what's happened to precious metals prices, maybe not in the last 2 months or so, but certainly year on year. If we look at what's happened to lumber prices, up 300-400%. You look at iron ore, you look at food commodities, any agricultural commodities, you know, and it's kind of a bit of my thesis that this inflation is permeating people's psyche, and the desire to buy property, I think, whether people recognize it or not, is part of an inflationary response, right? They recognize, they see inflation everywhere, and they know that if they don't get on the housing ladder, that when inflation really starts to take off, they'll be completely priced out. So there is inflation, maybe not in the CPI, not yet, but we're seeing it everywhere else.
Well, it's been an ongoing thesis from where I am, that we're seeing inflation that is almost deliberately removed from the CPI. But if you have a look at food prices have gone up more than double the official inflation rate over the last 10 years. Lumber in particular is interesting. And I was at a conference in March of last year, right before everything was locked down. And Benjamin Tal was there, Jennifer Keesmet was there, and so was Brad Lamb. And Brad Lamb was saying, as he was it was really just Jennifer Keesmet being angry at Brad Lamb and him being angry at her. But, you know, he made a really good point, which is that, you know, the costs of things keep going up. And as you point out, if it takes 5 years or 7 years or 10 years to get a building up on into market, you know, in that time, you've got a lot of price fluctuation that is extremely hard to control for. So I think at the time we just seen a few buildings cancel all the pre-orders in Mississauga because the prices had moved so much from the time that they'd begun the project to construction or pre-construction, that the down payments didn't work anymore. That math failed.
Right.
And I'm curious to know, is that a risk that you run as well?
Well, when we finance developments, you know, certainly it is a risk. You know, the pandemic has increased costs for a number of developers. It's usually one of our preconditions before we're financing anything anyway, that, you know, we require 70 to 80% of the contracts be placed. So that certainly mitigates a lot of that risk. But I do think that what we're going to see, because we're already seeing it, is that new projects that are coming to our table are at cost levels that 2 years ago we would have said, "Oh my God, how can you do that? It's just too expensive." And with lumber, cement, labor, COVID precautions, all these other things, it's like this is really just pushing the cost of developing things, which either means that housing prices have to, or apartment prices and et cetera, have to continue to go up, okay, to be able to afford that, or supply just stops, right? So this is one of the reasons why I talk about there being a lot of positive tailwinds. I mean, if you're an asset owner, this is just fun. If you're asset short, it's going to be very painful the next couple of years for you.
So let's talk a little bit then about the benefits of being an asset holder and then some of the risks that come along with it. A regular question I get is, well, what's the likelihood that we could lose value on an investment like the apartment REIT? And I have often said, well, look, there's a number of reasons why we're insulated from some of the things. But when people look at the market, real estate, all the different real estates go into a blender and it's turned into a slurry of kind of concern.
Yeah.
But you have made some strong positions about the kinds of things that keep, you know, apartments going, that keep the market supported, even when the economy looks very weak underlying it. Can you go over some of those for us?
Sure. I mean, it's very interesting you say that, because it's often a comment that I get. People have historically believed, falsely, and I've pointed this out for decades, that real estate is homogenous. It is not, right? Apartments are not houses. Residential is not commercial. Industrial is not office. And people just didn't always believe me, but I, you know, elucidated my thesis that it was. I think the pandemic has shown people once and for all that real estate is not homogenous. If you look at Manhattan tower occupancy rates today, 14 months or 13 months into the pandemic, they're still 5%, right? And same thing in, like, I don't, we've been out of office now for 13 months. And I think our tower occupancy rates in Toronto are very similar. Apartments were not having a problem filling up, right?
Mm.
So I think people have to distinguish between the sectors of real estate. The other thing is apartments, even if you compare apartment buildings to condominiums, they're similar drivers, right? Immigration's a driver of demand. Interest rates are drivers of demand. But there's some other things that drive them, which are slightly different. So apartments tend to be somewhat inversely correlated to the economy because, look, when people are concerned, they tend not to be buying houses. This is the first time I can think of in history in a recession where people are going nuts buying stuff, right? I mean, a lot of fun got made of CMHC for getting so bearish on Canadian housing last year, and they got that spectacularly wrong. But honestly, I mean, I think that was their projections were well informed. They
Yeah.
just completely misestimated, like most of us, the demand people would have to buy and try and get ahead of the inflationary storm.
Well, this is, the problem with being bearish in a market like this is that, things look so good. Stock market keeps going up. It's a bit
Yeah.
mixed these days, but we have the general trend is still positive. And as a friend I was speaking to the other day said, look, we've got huge holes in the economy. We've got all kinds of debt all over the place. And yet you can't go out and buy a house, a condo, a boat, a dog, a cat, a cottage. It's just everything is just, it's a fire sale. Or I
Yeah.
shouldn't say it's a fire sale. It's the opposite of a fire sale.
Yeah.
It's the reverse. People are paying top dollar for everything right now.
Mm-hmm.
So I do want to know though, because as you point out, we like the apartment REIT and we like
Yeah.
apartments precisely because they're a forgiving asset and because
Yeah.
we think they protect. But what are the situations that you can conceive of where something like the Centurion REIT would be in real danger of losing value?
Well, look, I mean, I think apartments and real estate in general are good, very good long-term investments, and they will correlate very well with the performance of inflation. And in an environment where interest rates are controlled, so in other words, you can borrow at less than the rate of inflation, so you can actually, in for the first time in history, or not in all of history because that's not true, but in my generation as an asset manager, and I've been doing this for 30 years, where you can buy an asset that provides a yield and where the money that you borrow can pay you a yield. In other words, you're borrowing for less than inflation. You pay back with the inflated dollars, and that's a great thing. But, one of the challenges I think for investors today, not only in this space, but in general, is because of the disruptions, there's all kinds of policies that politicians can bring in that can cause damage, right? So, most Canadians are sitting at home and yeah, they may not be happy about it, but they've actually got more money in their pocket than they had before because there's nothing to spend your money on. You're either receiving the same salary as you had before or possibly more on the CERB type programs. So you're probably otherwise feeling okay. But as this thing goes on, could we see, particularly if cost pressures start to go up, could we see populist policies like, in Ontario and BC, currently we are on a rent freeze, right? Because of the pandemic. But is it possible price controls can come out? Sure, why not? Because there's far fewer landlords than there are people who want to rent in our buildings. And the same thing, the same things happened in the 70s, right? Where they had price controls on almost everything. Wage controls, there was price controls on food and all these other things. So yeah, I always think about politics as being the greatest risk to in any business almost.
No, that's fair. I'm curious to know. I want to turn you a bit loose here, Greg, because one of the best parts about going to the annual general meeting, which obviously we haven't really had in the last year, is your presentation, where normally you eventually, I don't want to say veer off, but you go and give some very colorful commentary about how you view the political situation right now in the markets. Can I encourage you to share with us some of the thoughts that we haven't already touched on?
Sure. I've never been known for being restrained and being critical, certainly on the political side. I always knew that we had poor leadership. I am astounded at the poor quality of leadership we have, municipal, provincial, and federal, that has screwed up on so many levels and so extensively that, it frustrates me to no end. But I think what they've really done is they put Canada in a really, really difficult situation, not just now and through our recovery, but the amount of debt that's been taken on, I think, means that there is no solution other than an inflationary one. And that's going to be a very painful experience for a lot of people.
You're probably familiar with the theory of modern monetary, what's called modern monetary theory,
Or
which pardon, what's that?
The magic money tree.
The magic money tree. That's very good. And I understand that Christy Freeland, who is in addition to doing pretty much the job of the prime minister at the moment, and also the finance person, and also the chief diplomat, she is a big proponent of this. And I think Justin Trudeau is a big proponent of it too. They're certainly not alone. We're seeing a lot of the same, the monetary expansion. To back up, I remember when people said that Barack Obama's $700 some odd billion rescue package was going to be inflationary. And it's like a drop in the bucket to the kind of money that central banks have been printing today. And they're talking about being committed to this until like 2023. So years after we expect the pandemic to be behind us, we're still going to be spending big money and relying on the central bank to buy our own bonds that we have issued in the currency that they have printed for us.
Yeah.
I mean, it's highly experimental, and no one can really explain when it comes, when the thing comes unraveled or how it gets paid off, except for the fact that we can cancel our own debt so long as we owe it to ourselves. I guess you don't hold a lot of faith in that.
Well, here's the thing about modern monetary theory. It is not modern. Governments have been printing money or debasing their currencies since currencies first existed. I mean, the Romans clipped their coins 2,000 years ago and, reduced the silver content of their coinage, which was inflationary. So it's the same thing here. This idea that you can print money and that it's wealth just does not reconcile, right? To think about this from its core concept, the only things that you can consume have to be produced first. So if you paid absolutely everyone to stay home and do absolutely nothing, what is it that you buy? Because there is no food, there are no cars, there is no houses being produced, there is nothing to buy. So the quantity of money produced will directly correlate with inflation in the medium term. If you look back, the Weimar Republic in the 20s Germany, the same thing happened. They printed and printed and printed, and eventually it resulted in a hyperinflationary storm. I don't know if we get to hyperinflation here, but I am 100% convinced that we will at minimum be in a stagflationary environment. I mean, even though in Ontario they've talked about running deficits to 2029, now they're not even in their projections. They don't even put in that there's going to be a recession between now and then. So good luck with that. And the Feds, I think we're talking about 40 years before we hit budgetary balance. Good luck with that. So I have no view that MMT will ever get us out of this. In fact, I think it's the road to hell.
Subtly put. I had another question just about performance now. So
Yeah.
just turning back to the fund specifically. In the years leading up to the pandemic, so 2017, 2018, 2019, we were looking at double-digit returns in the 20% range on the apartment REIT. Obviously, that is not all made up of the income that the REIT generates. That was based on the value of the buildings appreciating. In 2020, that largely came to a halt. The buildings appreciated very little, as you obviously didn't, value them higher. That's understandable. Do you think that that's going to reverse course again in 2021? Are we going to be, if you're targeting, do you have a target kind of return that you think we might be heading in?
So my view for the next year is, look, we want to be setting ourselves up for the position where in the years ahead that we see inflation flow through. And right now, I do believe inflation's being disguised, certainly in the CPI. We're seeing it everywhere else, but it's not really reflecting. And we still have this overhang of the pandemic. People aren't moving, right? So we have rent freezes and we have immigration basically stopped. So, it's all these different disruptive forces, which are just saying, okay, from an operational standpoint, let's just keep things going. Rents are still increasing. I mean, when our report comes out, I think we year over year on units that turned over, rents went up 19%. Like, it's exceptionally strong.
Yeah.
But the number of units turning over is quite low, right? Because during the pandemic, no one wanted to do it. And we have a couple of these provinces which are have rent freezes in place. As those things roll off and the economy kind of normalizes, immigration, the borders reopen, I expect the rental market will go extremely tight again, and we'll start to see NOI ratios or net operating income ratios start to expand, rents to grow faster than historical trend, and we'll start to see an acceleration of returns in the years ahead. I think apartments are a great inflationary asset, and I think we are seeing a period not only of inflationary growth or stagflationary growth, but one where historically the returns of real estate are driven not only by inflation but by the cost of funds, right? And governments are artificially suppressing the cost of funds more than at any time in history. So I think that like I said, is the other side of that very good opportunity for apartment investors, is to be able to borrow. Like, we borrowed 10-year money fixed at 1.5%, 1.6%. Today it's, call it 2.25%. That's still cheaper than it was the beginning of 2020, and it's still sub, in my view, the cost of inflation. So yeah, I think we'll start to see things accelerate, but until we get past this COVID crisis or COVID storm, I think that those things will kind of be in a little bit of abeyance until then. So we just want to be setting ourselves up for that when it comes.
Okay, I'm going to open it up to questions. If anyone wants to ask a question of Greg, Greg is notoriously hard to get a hold of. Actually, so it's a great treat that he's joined us today. If you click the Q&A button, you can just type in, send me a question. Otherwise, we'll be wrapping up very soon. I'm just going to show that to you, Greg. That is a $100 trillion bill. From Zimbabwe, and it's the real deal. It's worth absolutely nothing. So on the subject of hyperinflation, it's probably not gonna, we'll probably never get there, but
no, I really hope not, because those periods of hyperinflation are exceptionally painful for almost everyone, right? And even if you're lucky enough to be in an asset that holds its value in real dollar terms, the fact of the matter is that governments have to tax that away from you. So even if you manage to protect your assets in real terms, you're going to lose it due to taxation, or a good chunk of it due to taxation, to cover the damage done to those that don't have inflationary linked assets that, end up starving. Right? I
Yeah.
mean, look at what happened in Venezuela, right? What was it, 3 years ago? The average Venezuelan lost 19 pounds or something.
Just through lack of food. Yeah. It
Lack
was
of food, right? It was just horrific. But that is one of the consequences of inflation.
one of the things I'm going to take one veer here, and then we'll sum up and let you go and just remind everyone what we've done today. But the Venezuela one is interesting because a lot of it was interesting. The Venezuelan Minister of Finance thought that inflation, that he was openly stating this, that inflation is a Western made up thing that's done by capitalist countries, which just really kind of summed up the state of affairs in Venezuela. But there is a kind of honest blindness that goes on with this, and it's very concerning. People don't realize. When you hear the MMT people talk, and I've read some of the books about it, they are very optimistic that no one will mind that you are going to print your currency, spend it, and then buy the bonds that you issued with the currency from the guys that printed it. This whole circular thing, and that's never going to be a problem. But what Venezuela found out was not that you can't print currency. You rely on too many other nations to import things to make things work. It's not that Venezuelans couldn't grow food. It's that they couldn't get parts for their tractors. They couldn't get seed that they needed from agricultural companies. They couldn't get fertilizer. And in Canada, we have the same problem. We keep assuming that this will not have an inflationary impact on our currency because we issue debt in our own currency. But if I was China, or I was the United States, or I'm any number of other countries, or Europe, and I look at Canada, I say I might not be so keen to get paid in Canadian dollars when I think that the Canadian dollar is fundamentally not worth what its stated value is. And I will simply ask that I get paid in US dollars or euros, forcing Canadians to buy those currencies to pay for those things that we want. And that's when we get that inflationary crunch. We've got no questions, so we must have done a good job today, Greg. So I want to thank you again. A reminder, the Centurion Apartment REIT is open. Many of the people it's the number one asset inside our portfolio. So it's great to have you on here. But if you are interested in approaching some more of it, I encourage you to speak to me directly, because obviously I should be giving you some personal feedback. If you want, the recording of this will be shared on YouTube. Lastly, we will be having Stephanie Hughes, a young freelance journalist, joining us next month. So I'm going to say thank you to Greg for joining us today.
Thank you.
And I'll see everyone again on our 4th webinar in May. So thank you very much.